Somewhere in Switzerland right now, a single company is manufacturing more than 1 million watches a year, generating an estimated $10 billion in annual revenue. And not one single share of that company is owned by anyone. Not a founder's family, not a hedge fund, not a luxury conglomerate. Nobody. Rolex doesn't have shareholders. It doesn't have a stock ticker. It has never gone public, and by design, it never can. And that one strange fact, more than the gold, more than the marketing, more than the celebrity wrists it's photographed on, is the real reason a steel watch with a movement no more mechanically necessary than a smartphone's clock can sell for 2, 3, sometimes 10 times what it costs new. By the end of this video, you'll understand exactly how Rolex became one of the strangest, most successful businesses on the planet, and why its ownership structure alone explains almost everything else about it. Most people assume Rolex is expensive for the same reason any luxury brand is expensive. Clever marketing, brand prestige, some materials markup. That explanation isn't wrong, but it barely scratches the surface. The real story involves a decision one grieving widower made in Switzerland in 1944, a manufacturing philosophy almost no competitor has been able to replicate at scale, and a secondary market so active that a watch can be worth significantly more the moment you walk out of the store than the price you just paid for it. By the end of this video, you'll understand why Rolex refuses to flood the market with supply, even though it easily could, why its production process is genuinely unlike almost any other luxury manufacturer, and why the person reselling a Rolex a year after buying it might make more money than someone investing the same amount in a savings account. Rolex is a private company and doesn't publish detailed financial statements, but a great deal is known through industry analysts, including Morgan Stanley and Lux Consult, who publish annual estimates of Rolex's revenue and production volume, Swiss watch export data, tracked by the Federation of the Swiss Watch Industry, and extensive secondary market pricing data, compiled by watch dealers and auction houses that track resale values in real time. This video draws on those public sources rather than any insider information, because insider information on Rolex barely exists. Secrecy, as you'll see, is part of the business model too. Quick note before we go further. This video is for educational purposes only and isn't financial or investment advice. Watch markets, like any collectible market, can be volatile. Prices can fall as easily as they rise, and past appreciation is never a guarantee of future returns. With that said, let's start with the decision that made all of this possible. In 1944, a German-born watchmaker named Hans Wilsdorf lost his wife, Florence. He was 63 years old, orphaned since childhood, and had no children of his own to inherit the company he'd spent nearly 4 decades building. Rather than sell Rolex or pass it to distant relatives, Wilsdorf made an unusual choice. He created a private charitable trust called the Hans Wilsdorf Foundation, and in 1960, shortly before his own death, he transferred his entire ownership stake into it. Here's why that single decision still shapes every Rolex you see today. Under Swiss foundation law, once assets are placed into a foundation like this, they must permanently serve the foundation's stated purpose, which means Rolex, by legal structure, can never be sold, acquired, or taken public. There are no shareholders anywhere in the ownership chain. Every dollar of profit either gets reinvested directly into the company or flows into the foundation's charitable initiatives. Think about what that actually removes from the equation. Picture Alex, an investor considering buying shares in a typical public company. Alex expects quarterly earnings calls, growth targets, and pressure on management to maximize short-term returns, sometimes at the expense of long-term brand health. Rolex has none of that pressure, because there's no Alex in the picture at all. No public shareholders demanding quarterly growth. No private equity firm pushing for volume increases to hit a return target before an eventual sale. No luxury conglomerate boardroom weighing Rolex's margins against a dozen other brands in the portfolio. This is a genuinely rare structure in global business, and it's the foundation, no pun intended, for almost everything else we're about to cover. Because once a company is insulated from short-term financial pressure, it can make decisions most public companies simply can't afford to make. And the clearest example of that shows up the moment you look at how a Rolex watch is actually built. Here's where things become interesting from a manufacturing standpoint. Most luxury watch brands, even fairly prestigious ones, don't make every component of their watches in-house. A typical mid-tier Swiss brand might buy its base movement from a specialist supplier, its cases from another manufacturer, its dials from a third, The brand's real expertise lies in design, assembly, and marketing, not necessarily in producing every single part from raw material. Rolex does something almost no other watchmaker at its scale attempts. It manufactures nearly every component itself, entirely within Switzerland. The movements, the cases, the dials, the bracelets, even proprietary materials like its own steel alloy and its own gold, refined in its own foundry. Rolex operates multiple dedicated facilities across the Geneva region, each handling a different stage: movement production in one location, case and material work in another, dial and gem setting in a third, with final assembly bringing every component together. This is what economists call vertical integration, controlling your own supply chain from raw material to finished product, rather than depending on outside vendors. It's extremely expensive and slow to build, which is exactly why so few companies attempt it at real scale. But for Rolex, that control translates directly into consistency. Every single watch is tested to Rolex's own internal chronometer standard, a precision benchmark stricter than the industry standard certification most Swiss watches carry. Here's the part that surprises people most. Despite all of this painstaking in-house craftsmanship, Rolex isn't actually a small, rare manufacturer. Industry estimates place Rolex's annual production somewhere around 1 million watches a year, genuinely enormous by luxury standards, more than 15 times the volume of a brand like Patek Philippe. So if Rolex is producing watches at that kind of scale, why does it remain so famously difficult to walk into a store and simply buy one? That question leads directly into the most misunderstood part of the entire Rolex story. Most people assume Rolex deliberately restricts supply purely as a marketing tactic: manufacture scarcity, drive up demand, classic playbook. There's a kernel of truth buried in that assumption, but the reality is more specific and more interesting than simple manufactured hype. Because Rolex insists on producing nearly every component in-house, its production capacity is fundamentally limited by physical manufacturing infrastructure, machinery, skilled labor, factory floor space, not simply by a decision to hold back inventory. A brand that outsources components can theoretically scale production faster by leaning on outside suppliers. Rolex, by choosing vertical integration, effectively capped its own maximum output at whatever its own Swiss factories can physically produce. That's precisely why the company is currently investing roughly $1 billion into a new manufacturing facility in Bully, Switzerland, set to open by the end of the decade and expected to employ around 2,000 additional workers. A direct, expensive attempt to raise that production ceiling. But here's where things become even more interesting. Even at roughly 1 million watches a year, demand for Rolex's most popular sports models, the Submariner, the Daytona, the GMT Master II, still dramatically outpaces what authorized dealers receive. Reports place waitlists for the most in-demand references at authorized dealers at multiple years for some models, even though Rolex is, by any reasonable measure, mass-producing watches compared to smaller competitors. Consider Sarah, a longtime customer walking into an authorized Rolex dealer hoping to buy a steel Daytona at the listed retail price. Even with the cash in hand and full willingness to pay full price, she may simply be told there's a wait list measured in years, not because Rolex is playing games with her specifically, but because the honest gap between global demand and physical manufacturing capacity is that large. This isn't purely manufactured scarcity in the traditional marketing sense. It's genuine scarcity created by a business model that prioritized craftsmanship and quality control over maximizing volume, colliding with genuinely enormous global demand. That gap between what people want and what's actually available at retail is where the story gets financially fascinating, because it created an entire secondary economy that most other consumer products simply don't have. Here's something that sounds almost impossible in most other areas of retail. For many current Rolex models, the moment you manage to buy one at the official retail price, it can immediately be worth significantly more than what you paid. Pricing analysis from watch dealers has documented steel Daytonas retailing around $17,000 while trading on the secondary, or gray, market for well over $20,000, sometimes a premium of 30 to 50% above retail, purely because so few people can actually access one through official channels. This creates a genuinely unusual economic dynamic. Normally, when you buy a consumer product, a car, a television, a pair of shoes, it loses value the moment you walk out of the store. Certain Rolex models behave the opposite way, at least for a period of time. because the retail price is artificially held below what the free market would actually pay, given how limited the official supply is. Picture Michael, who spends years building a purchase history with an authorized dealer specifically to eventually get access to a highly requested Daytona at retail price. The moment he receives that watch, he could, in theory, immediately resell it on the secondary market for meaningfully more than he paid. Some buyers do exactly this. Most collectors don't, because the appeal is wearing the watch, not flipping it. But the fact that flipping it is even a realistic, profitable option tells you everything about how unusual this pricing structure is. This dynamic has led some financial commentators to describe certain Rolex references as behaving less like a typical depreciating luxury good and more like a scarce, actively traded asset, something closer to a limited edition sneaker or a piece of art than a wristwatch. It's worth being careful here, though. This pattern applies mainly to a handful of the most in-demand steel sports models. The vast majority of Rolex's actual production, everyday date justs, Oyster Perpetuals, and other widely available references, doesn't carry anywhere near the same secondary market premium and can lose value like most consumer goods, especially once worn and resold. Understanding this distinction matters because it leads to an important question. Does any of this actually make Rolex a smart financial investment, or is it something else entirely? Here's the real reason financial-minded viewers should be cautious about treating watch resale premiums as an investment strategy, the same way they'd think about stocks or index funds. Unlike a share of a publicly traded company, a watch generates no dividends, no interest, no ongoing cash flow. Its entire potential return depends on someone else being willing to pay more for it later, which makes it fundamentally a speculative, demand-driven asset, not a productive one. The data backs up how volatile this can actually be, even for the most desirable models. Pricing trackers show the Steel Submariner's secondary market price climbing from around $9,000 in 2020 to a peak near $18,500 in 2022, before settling back down closer to $13,500 by 2025, still well above the launch price, but a meaningful drop from the peak. The Daytona followed a similar arc, roughly doubling in secondary market value between 2020 and its 2022 peak, before pulling back significantly in the years that followed. This pattern should look familiar to anyone who's studied speculative markets before. A rapid demand-driven spike, followed by a correction once buying enthusiasm cools. The 2020 to 2022 period coincided with historically low interest rates, pandemic-era stimulus, and a broader surge of retail speculation across collectibles generally, from sneakers to trading cards to, yes, watches. Some of that Rolex price surge reflected genuine long-term brand strength. A meaningful portion of it also reflected the same speculative momentum that inflated plenty of other collectible markets during that same window, and momentum like that doesn't reliably persist forever. This is why treating Rolex resale value as a guaranteed investment vehicle misses the point of why the brand actually built this kind of value in the first place. Durability, craftsmanship, and disciplined brand management, sustained over generations, rather than any single speculative cycle. This raises an obvious question. If the formula is this well understood, restrict supply, control every part of manufacturing, maintain relentless quality standards, why hasn't every luxury brand simply copied it? The honest answer is that most brands structurally can't. Nearly every major luxury competitor, Cartier, Omega, IWC, sits inside a public conglomerate like LVMH, Richemont, or Swatch Group, all of which answer to shareholders expecting consistent, predictable growth. That pressure pushes those companies toward decisions Rolex simply never has to make. Expanding production faster than manufacturing quality can comfortably scale, chasing next quarter's revenue targets, or diversifying into adjacent product categories to satisfy investor growth expectations. Rolex's foundation ownership means none of that pressure exists. The company can let a waitlist stretch for years rather than rush a factory expansion that might compromise quality control. It can spend a full decade and $1 billion building a single new facility rather than outsourcing components to hit a faster timeline. It can operate with almost no public marketing spin, rarely giving interviews or making public statements, because it has no quarterly earnings call to manage and no stock price to defend. That's the real, structural moat behind Rolex's pricing power. Not simply a clever brand story, but a business model that most of its competitors are legally and financially incapable of replicating because they answer to shareholders Rolex has never had to answer to at all. Here's why this matters well beyond wristwatches. Rolex is one of the clearest real-world examples of how ownership structure alone can shape an entire business strategy, independent of the product itself. Two companies could make functionally similar products, yet make completely different decisions about pricing, scarcity, and quality, purely because one answers to shareholders demanding quarterly growth, and the other answers to nothing but its own founding mission. The lesson isn't that every company should become a non-profit foundation, or that scarcity alone creates value. Plenty of scarce products fail commercially every year. It's that understanding who a company actually answers to often explains its strategic decisions better than studying the product on its own ever could. The watch on someone's wrist tells a story about craftsmanship. The ownership structure behind it tells a much bigger story about incentives. And incentives, more often than most people realize, are what actually drive a business's long-term behavior. So the next time you see a Rolex, in a store window, on someone's wrist, or in a headline about resale prices, you'll understand what's really behind it. Not just gold, not just marketing, but a genuinely unusual ownership structure, an unusually disciplined manufacturing philosophy, and a secondary market shaped by a scarcity that's more structural than staged. It's a business model very few companies could copy even if they wanted to, and that, more than anything stamped on the dial, is what the price is really paying for. If this changed how you think about luxury pricing, hit like, subscribe for more videos like this one, and let us know in the comments, which brand's business model should we break down next?